going to start as well, the recording as well.
Excuse me.
Yes.
Did we cover linear scheduling methods, or we just missed it, skipped it?
No, we did not skip it. We already covered. I did not explain it more, but you can see it from the book. So if there is any question, maybe you can ask it. And maybe I will also upload an additional PowerPoint regarding that. So it's included. I did not skip it. It will be included. Okay. Although I did not explain it in details. Is it okay?
Okay, thanks.
Or do you want detailed explanation? Okay, so okay, can you see this PowerPoint slide?
Yes.
Yes.
Okay. Just a minute. I need to remove this animation. Slideshow. Slideshow. Show without animation. I don't want animation. Okay. So today's topic is construction economics. So in this topic, we will look at the economic aspects of construction. Just give me a second. Okay. So introduction. So construction contracting is a highly competitive business. Financial management of a construction company is equally as important to company success as its technical management. So a strong technical base supported by business skills and management ability provides the best foundation for success as a construction professional. So the purpose of this topic is to introduce the terminology and basic principles involved in determining the owning and operating costs of construction plant and equipment, analyzing the feasibility of renting or leasing rather than purchasing equipment, and the financial management of the construction projects. So it is very important to have the financial management performed in a proper way for the construction company. So the major failure for most of the construction companies is their inability to deal with the financial aspects of the project. And these financial aspects of the projects also are also become more problematic because of the improper estimating methods in the project, improper cost estimates. Technical aspects are important, but it has been found that most of the construction companies fail due to the financial aspects. So therefore, so in this topic, basically, three main subtopics will be discussed. The costs of construction equipment, and the decision to whether buy the equipment or rent the equipment. And the third aspect is the overall financial management on construction projects. So today we will be looking at the aspect of the construction plant and equipment. And in the next class, we will be looking at the other two topics. So hopefully we can complete this topic within this week, or maybe some part of this will also go into the next week as well. So what we have over here is, we start from the time value of money. So this is a concept, this is the basic concept which is applied in the engineering economics, time value of money. So to understand this concept, we have to look at the situation of depositing the money into the bank or borrowing the money from the bank. So in those situations, when you deposit the money in the bank, you earn an interest on the money. Or if you borrow the money from the bank, you pay the interest to the bank on the amount borrowed. Okay, so the simplest of the situation is that when you when you borrow some amount, okay, or for simplest of the situation is that when you deposit some amount P into the bank account and the bank gives you an interest of say I% per year, and you put that money into the bank for n number of years. So after n number of years, your deposit will become equal to the value of F. Okay, so it will become equal to the value of F. So F is equal to P into 1 plus I power n is the formula which is called as the compound amount after a number of years n. So everyone is aware that the amount of money held in a savings account will increase with time if interest payments are allowed to remain on deposit in the account. Okay. So this type of concept of time value of money arises in the construction project because for construction, you have several of the applications of this time value of money. So because many of the construction companies many of the construction projects are started when a construction company borrows some money or takes a loan from the bank. Okay, so when the construction company have to return that loan to the bank, then this time value of money concept will come into the picture. Similarly, if that amount has been borrowed to purchase that equipment, so whether that equipment is useful for the company or not, it can be gauged against the cost of capital. That means you have purchased that equipment on some borrowed money, or then you have to compare it against compare that borrowed money against the benefits and cost which you are achieving for the equipment. So that will involve the time value of money concept as well. So various type of situations can arise in the time value of money. One of that situation is that you can have this single payment compound interest, okay, situation, which is this situation when you get the value of the future in the future when as a result of when you deposit some amount. Okay. The opposite of that is that if we want to get the value of P from F, so the formula will become P is equal to F over 1 plus I power n. Okay. So this is called as the single payment present worth factor. Okay. So there in the engineering economy, there are different names for these terms. So P and F are there in these formulas. So in addition to P and F, there are some factors which only depend on the interest rate and the number of periods for which the interest is calculated, or the number of years for the interest for which the amount has been borrowed or deposited. So N is the number of year, I is the interest rate. So if you take this factor 1 over 1 plus I power n out from this equation, this factor then is called as the single payment present worth factor. Why we call it as a present worth? Because it calculates the present value of a future amount. okay, present worth of a future amount. So for example, if you are going to get like $5,000 in 5 years from now, so what is its future, what is its present worth at an interest rate of 10%? So we can get it on this formula. So it is the present single payment present worth factor. So in this case, we are for these two formulas, f is equal to p into 1 plus I power n, or p is equal to f over 1 plus I power n. These two are essentially the same formula in different forms. We are using the single payments. We are considering that, okay, we deposit one amount now, and then we get a single amount later on. Okay, so this is one case. In another case, what we can see is that we can deposit on annual basis or on monthly basis some amounts which are equal to A. So instead of depositing $12,000 at the end of 1 year, you may also choose to deposit $1,000 every month for 12 months. So these $1,000 every month will become the value of, can be represented as A. So in this case, there is not a single payment, there are a series of payments, okay? So there are a series of equal periodic payments, A. So when those series of equal periodic payments are made or deposited into some account, so what is their accumulated value at the end of a period n, and when an interest rate of I is used? So this is given by this formula, f is equal to A into 1 plus I power n minus 1 over I. Have you come across these formulas before?
No.
Did you study these formulas before in your, for example, economics course?
The first one I think we studied, but the second one I'm not sure.
Okay.
First one we studied,
but not exactly like this. But the concept is like usual for us, I think.
Yep. Okay. Yeah. So yeah. Okay. That's enough information for me. Okay. So in this case, we get the future value. Okay. And then we have another formula. So in this case, the present value. Okay. So for example, if we deposit the amounts A for n number of years, what will be the future value we will get in the future? Similarly, what amount in the present will justify if we want to get some values A periodically for n number of years? Okay, what amount is justified now? Okay, so and that is given by this formula. So P is equal to A into 1 plus I. So this is called as the uniform series present worth factor. Okay. And on the other hand, the opposite of this F is equal to A formula, that is in this case, we have this A is equal to F into I over 1 plus I power n minus 1. Okay. And this is called as the sinking fund factor. That means the periodic payment required to accumulate a desired amount at some future time. What are the periodic payments we need now? And another one is the opposite of this. P is equal to A. We have the A is equal to P. So the annual cost to recover an investment, including the payment of interest over a given period of time. So this is called as the capital recovery factor. So annual cost to recover an investment, including the payment over a given period. So these formulas are very conveniently included into the Microsoft Excel. So for example, let me go open the Microsoft Excel over here. Okay, can you see this Microsoft Excel?
Yes.
Okay. So suppose suppose you deposit in the bank account $100. Okay, just now I just and the bank gives you an interest of say 5% per year. So I give the value of P and I, something like this. Okay. So P. And what you want to know after 5 years, how much will be the future value? N. So it will be 5. So it is 5% per year. It is 5 years. So it is per year. And this is year. Then it's this amount is done. So you want, if I want to find the future value, F. So we can use the formula. Okay. F is equal to P into 1 plus I power N. This formula. Yeah. Okay. Okay, maybe you can use this formula. Okay, F is equal to P into Y plus R. So if I will use P is this multiplied by 1 plus I is in already in percentage, and power N, which is this. So I will get a value of 127.63, right? So the same answer I can get from the inbuilt function. So that inbuilt function, so F from Excel, okay, Excel is equal to from the Excel formula. So for this, I will use a function which is named as FV. FV, okay. So FV, I will need to give a value of, so for example, it will need to give the value of the rate. Rate is 5%. And then I will give the value of N per number of periods. So number of periods are 5. And I will need to give the PMT value. PMT is the number of values in the present time. So I will skip it because there are no number of periodic payments. Okay, periodic amount, PMT are the periodic amounts. I will skip it. There is only single payment in this case. Okay, and then the last this value is PV. Okay, PV is the present value. So this is the present value, B1. And then I will close the bracket. And the last one is the type. So just it is optional. So just leave it blank. Okay. And then, yeah, we will get the same value, but over here it is the answer is given as negative. Yeah, the negative means you will. This is just the context in the context. So, for example, if we are saying that this is the deposited amount, and this is the amount which you will get. So in this case, then I think you will put minus B1 over here because this B1 value, that is this value, this is the deposit amount. Okay, so you can put a negative value over here, and in this case, you will get a positive answer. So 127.63. So which is the same answer. That means Excel has these inbuilt formulas for these functions. Okay, so as another example, if, for example, instead of P, you deposit, say, $80, okay, or $90 every month, okay, $90 per month, okay. Yeah, it is $100 per year, and then I'm just taking like $90 per month, and the bank gives you an interest of per year, okay, per year, and then for this is the number of year, and so in this these are the uniform series of payments, okay. Okay, so per month. So then what will be the value of F in this case? So this is the single amount. Okay, this is the single amount. This is the single amount. But here I am taking these $90 per month. Of course, there is no comparison between these amounts. So maybe I can say, okay, instead of $90, I can take $9 just to take some comparison. Like, for example, if it is 9, that means in 5 years, 60. Yeah, okay, I can still take, say, maybe $2 per month. Okay. Anyway, so what will be the future value in this case? So in this case, now it is A. So it is in terms of the Excel, it is the PMT value. Okay, this is the PMT value. And in terms of the Excel, this was the PV value. Okay, in terms of the Excel. So if I want to apply this formula, and what is the formula which I want to apply over here? This one, this formula. Oh no. So, okay. If I want to apply this formula, so then how I will apply? So I will take the value of A, then I'll put equal sign A and multiplied by bracket 1 plus 5% power N. So N will be how many? So because in this case now, because these are the payments are monthly basis, so we should also take the interest on monthly basis as well. So we will assume that 5% divided by 12. Okay, so it will be, that is equal to A, okay, multiplied by 1 plus 5%, because that is per year. So divided by 12, it will be per month. And its power, and then there will, for 5 years, there will be how many months?
60
months. Okay, so I will take 60, and then I will take minus, and then I will take bracket close. I need to put one more bracket over here, and then I will divide by interest rate. So interest rate is again this 5% divided by 12, and then this will be the value of F. So I get some error over here. So what is that error? Yeah, here I think I must put, no, this is some error. Okay, so yeah, yeah, 136.011. Okay, accumulated value is 136.01. But if I want to find the same from Excel, so I can use this formula. So it will be FV, same formula. Rate is 5% per year. I will divide it by 12. It will be 5% per month. NPER, these are the periods, 5 years multiplied by 12. These are the number of periods. And now in this case, payments, PMTs, these are the amounts which we are depositing every month. Because these are the amounts which we are depositing, that means this is the amount which are going away from us. So I will take negative and then this value over. And then that's all we need over here. We will close the bracket and then we will get the same answer, 136.01. Okay, so here you can see that if you have two options, in the bank. One option is that bank says that, okay, you deposit $100 now, and the bank will give you 5% per year for 5 years. Then you will you can withdraw $127.63. The other option is that you deposit $2 per month, and the bank gives the same interest rate and the number of years. But the thing is that this interest rate can be compounded monthly, on monthly basis. Then you can calculate that you can withdraw $136.01. So which option in this case you will take?
Second one.
Yeah, it's the second one. So in this case, for example, you are depositing like, no, I think it's not, you are depositing like equal to 2 times, how many? 60. Yeah, actually you are depositing like 120, right? So it's actually not very equivalent. Maybe if I take, for example, okay, let me, if 100 divided by 60, if it is 100 divided by 60, it is 1.667. If I take this amount, if I deposit this much amount over here, then how much I will get? Yeah, I think, oh, sorry. $113.37. Okay, so it means that I think we should take this option. Yeah, just deposit $100 now and then get $127.63. But if you deposit 1.667, total deposited in 5 years is same, but you will get only $113.34. But anyway, it depends on your situation as well, because maybe you don't have like $100 now. Okay, this is the big amount, but you may be able to afford it this much amount. Okay, so just yeah, okay.
Do you consider now the situation when we like giving to someone money? Yes, we are as bank, or
yes. We're, I am considering a situation when we are depositing some amount into the bank.
yeah. So okay.
May I ask, Professor?
Yes.
Well, about the second case, we have an equal amount of money which is paid on the monthly basis. It's $2 per month, and we have an interest rate from bank which is 5%.
Yes.
But it's 5% is per year. Why can't we just take our $2 multiplied by 12, and it will be $24 per month? So I mean, is there a difference because bank?
Yes.
Because bank has interest rate on year basis, not on months.
No. Bank even have the interest rate on continuous basis as well, or even on the daily basis as well. This 5% per year is the what they will show you an equivalent in 1 year. Okay, when they will show it. But normally they charge the interest on daily or monthly basis. So if, for example, if you will take like $24 per month, $24 per year, okay, and then you can apply, then it will be also, you will get the difference also. In that case, we will assume that interest is only calculated after every year, okay? So that will give you another answer. So for example, in that situation, if you take it like this, maybe I can do it here. So if it is $24, okay, and I just calculate from Excel, okay. So if it's $24 per year, so what you will get? So equal to FV, and then 5% per year, then for 5 years, and then it is 24. So you will get 132.62. Okay, so it will.
No, I meant 24 in 1 year, because if you have $2 per month, it will be 24 in 1 year. And I asked, is there any difference if we will take so, because interest rate is taken on a year amount of money. On a
No, it's
amount
not.
of money.
It's not correct that if, the interest rate is only taken after every year. In most in most of the banks, they charge the interest on daily basis.
No, exactly in this case, which you showed.
Yes, so now I am showing it now, okay. So 24, and then it will be FP. And then this, and then minus. So it will be 132.6 in this case. Yeah, so in this case, this is per year. Okay, this is per year. And this is per year, but this is per month. Okay, so this will be the difference.
Okay, can you put 2 instead of 1.667 over there?
Okay, 2. Okay, yes. Okay, yes. So if it is 2, then 136.01. But if it is 24, then it is 132.62. The reason so why this amount is higher here than here is that because now you are getting the interest after every month. So the equivalent interest which you will get in 1 year will be more in this situation than in this situation. So that's why you will get more amount in the future in this case than this case. Okay.
But it is uniform. I mean, the interest is uniformly distributed as since you divided that by 5% into divided it by 12. So actually,
yes, but because it is compounding every month, in this case, because it is compounding every month, so the amount accumulated will be more in this case. So just like this. Yeah, so if you, for example, it is you can show it as well over here. In this case, what I can show is like the number of periods. Okay, 0, 1. So in this case, how many we will go up to 60. Okay, so what is the initial amount over here? Okay, what is the amount over here is 0, and over here. So now we are considering like $2. Okay, so $2, and what will be the interest on that? Interest I. Okay. So the interest will on that $2 will be because after
5 over 12.
Yes, so it will be 2 multiplied by 0.05 divided by 12, right? This will be the amount of interest. So now after earning the interest, the amount will become this plus this. Okay, 2.008. Okay, so this will be at the end of the first period. Okay, so this is the same amount which will be 2.08. So and then $2 will be deposited. Let me. Okay, so $2 will be deposited again. Okay, and then the amount will, what will be the amount that will become? Initially, this is the amount which you deposited. Okay, and plus here, this will be the amount. So what will be the interest on this?
5%.
Yeah. it will be calculated by the same formula like this. Okay. So I think this will be end 1, 2. And so here you can see that I'm taking the situation after every month, every 1 month. So at the end of first month, okay, you will get this. So for example, you deposited $2 now, and then you will get this much. And then you deposited $2 again, then you will get this one. And then your total will become how much? This one, 4.008, then this. Then you will deposit it 2 again. And
2 plus 4.002.
yes, so it will go like this. So at the end, you will accumulate 136.01. Okay, 136.01 amount over here, because this will be the amount at the end of 136.01 amount. So which is the same which we have calculated. On the other hand, if you will do for this case, now, so in this case, you will have n, how many? 1, 2. So we will go for how many years? 5 years. Okay. So you deposit how much? So here you have 24. So on that 24, what will be the interest? 24 multiplied by 0.05. So that will be the amount accumulated at the end of the first year will be this value plus this value. And then okay, then you deposit 24 more. So the amount will be this plus this, and you will go like this, and then 24 like this, and if I continue like this, 132.61. So you can see that I will get, you will get the same amount, 136.62, 132.6. So you can see that here the number of compoundings is only after 1 year. Okay, but here so many compoundings within 1 year. So based on this compounding of the interest, then the amount accumulated will be much more than in this case. Okay.
So can I please click on the I4 block, which is calculation of F? 1260. Oh, yes,
yeah?
it's this one. I just want to look at formula.
Yeah, this is the same formula, right? This is the same formula which I used.
So if we're given paid amount, for example, in months, we have to take our periods also in months. If we're given years, we have to transform it to months.
Yes, yes. So your number of your payment schedule should also match with the schedule for the interest calculation. So if the interest calculation is on the monthly basis, so the payment should be also in the monthly basis.
And also a question. Oh no, it's okay. I noticed it.
Okay. Okay, so in anyway, I just go off track a little bit, although it was not the main topic of this over here. There was just only an introduction. But anyway, we had some lively discussion over here. So similarly, we can use these formulae over here. Anyway, for example, in the Excel, if we want to, for example, in Excel, there are different functions, but all use the same internal formulas over here. So if you want to find the, if you want to find A, okay, then you will use this PMT function. If you want to find F, you will use the FV function. If you want to find P, then you will use the PV function. If you want to find N, you will use NPER function in Excel. And if you want to find the interest rate, you can find it by IRR function or rate function. No, rate function. IRR is for another. So these are the Excel functions, okay, which you can use. So all of these Excel functions which you can use, then they internally use these formulas. Okay. So, for example, in this case, if P is given, I is given, N is given, we can find A. But in Excel, we will use a PMT function. Okay. And yeah, and for this formula, that means for this formula, we will use the PV function, okay, in Excel. Okay, so the time value of mean, so these equations form the basis of a type of economic analysis commonly called the engineering economy. Okay, so earlier in our Nazarbayev University, we had this course, engineering economy, and I have taught this course for several years. But before then, this course was replaced with your managerial economics course. But I think your managerial economics course, or I don't know what is the name of that which you use, is not the same as this engineering economy course. So this was one of my favorite courses before. Anyway, to analyze the economic feasibility of proposed projects, to compare the alternative assessments, and to determine the rate of return of an investment. So the time value, the engineering economy is very useful to analyzing the economic feasibility of the proposed projects, compare the alternative investments, and determine the rate of return on an investment. So rate of return of an investment means it is actually finding the interest rate, unknown interest rate. So for example, over here, if we use this equation or any other equation from here, for example, this equation or this equation, if you don't know this interest rate from this equation, okay, so we can use the Excel function rate, and then that Excel function rate will calculate it. But if you will do it manually, then there is no direct method to doing this. So you will need to use the trial and error method to find the interest rate, because there is no direct equation which you will get that will give you. So finding the interest rate is the same as finding the rate of return of an investment. But of course, there are some different situations where we may use even some other formula in Excel as well. Because of their complexity and difficulty of accounting for the benefits of inflation and taxes, these techniques have not been widely used in the construction industry. Although we can use this engineering economic principles in the construction industry, but they have not been widely used because of the effects of inflation and taxes also have to be included sometimes, which makes the analysis rather little bit difficult. So that's why, due to this purpose, these type of analysis have not been much used. However, this may be the thing of the past, because now with the wider use of the worksheets, spreadsheets, and specialized software, so any type of engineering economic analysis can be done very easily. A present worth analysis is very useful when comparing the cost of different alternatives. So yeah, later on there may be one example for that when we are doing the rental and buying decisions for the equipment. So we will illustrate with the present worth analysis. Okay, so one of the main subtopic in this topic is the equipment cost. Okay, so there are certain elements of the equipment cost, owning costs, and then there are the operating costs as well. In the owning costs, we have the depreciation, investment, insurance, tax, and storage, and then there will be total owning costs. And then there, in addition to the owning cost, there are the operating costs as well. So the difference between the owning cost and the operating cost is that the owning costs are do not depend on the usage of the equipment. So once we have the equipment or the machinery, whether you use that machinery or not use that machinery, you have to incur those costs. Or on the other hand, there are the operating costs which only incur when there is the usage of the machinery. So we need to consider these two costs one by one. So let's first consider the owning costs. So estimate the equipment elements of equipment costs. So first, normally what you do in the estimation of the equipment cost, we estimate the equipment's hourly production. That means how much work an equipment can do in 1 hour. So that hourly production is then divided by the, that means the equipment's hourly cost is divided by the hourly production to obtain the cost per unit of the production. Okay. So we have the hourly production and then the hourly cost. So if hourly cost is divided by the hourly production, we get the cost per unit of production. But for this, we need to use the hourly cost. So this is the purpose of considering the costs. So the hourly costs, we need to find it. So we need to consider the methods for determining the hourly cost of the operation of an item of equipment. So this hourly cost is necessary to estimate. For this, it is necessary to estimate many factors, such as the fuel consumption, tire life, and so on. So the use of historical data recorded by your construction company operating similar equipment under similar conditions, and consult the equipment manufacturer for the recommendations. So the necessary data which is needed can be obtained from the historical records and can also be provided by the manufacturer of the equipment as well. Okay. So this was just the introduction of the elements of the equipment cost. Equipment owning and operating costs. So there is a term which is frequently used, O&O costs. These are the owning and operating costs. So the difference between the owning cost and operating cost is that owning costs are fixed costs that are incurred each year, whether the equipment is operated or not. Operating costs, however, are incurred only when the equipment is used. So that I just explained 2 slides before as well. Okay, so now let's look at some of the costs. So one of that cost is the depreciation. Okay, so okay, now I think you will say that what is a depreciation? So when we say the depreciation is a decline in the market value of an item of equipment due to age, wear, deterioration, and obsolescence. So this is the definition of the depreciation. So when we buy an equipment and then the value of the equipment decreases with the passage of time. During that time, the equipment is used, the equipment goes wear and tear and deterioration. So the value of that equipment decreases. So for example, a car purchased now maybe cost $25,000, but maybe after 5 years usage, the value of the car may decrease to say only $10,000. So that is due to the depreciation. So depreciation in the accounting terms is considered in the economic analysis because, for example, if an equipment which is purchased now was $50,000, so after every year the company have to submit the financial documents to the tax department. So in the financial documents to the company also mentions the value of the assets it's owned. So if an equipment which was purchased $25,000 1 year before, and then after 1 year, the company will still say that the value of that equipment is $25,000, then the company will need to be unnecessarily pay more taxes. Okay, because the more the value the company will show, the more will be the property taxes, the more will be the income taxes the company will have to pay. So therefore, for the tax liability, the companies are allowed to use the depreciation to show the reduced value of the equipment. So it is used for 2 separate purposes: evaluating the tax liability and determining the depreciation component of the hourly equipment cost as well. So for tax purposes, many equipment owners depreciate the equipment as rapidly as possible to obtain the maximum reduction in tax liability during the first few years of the equipment life. So this is customary that to reduce the value of the equipment as rapidly as possible. So in calculating the depreciation, the initial cost of an item of equipment should be the full delivered price, including the transportation, taxes, and initial assembly and servicing. For calculation of the depreciation, we normally consider the purchase price of the equipment. However, that purchase price of the equipment should include these transportation, taxes paid initially on the equipment, such as the sales tax, or assembly and servicing, or the installation charge is also included. So this is called as the base price, base cost of the equipment for the depreciation purposes. One thing which is especially different, which is special for the construction equipment, is that most of the construction equipment are the trucks or other cranes, etc., which are mounted on some wheels, and these wheels may have some tires as well. So the cost of tires is separated out from the depreciation, because the cost of tires may be also quite significant, but these are separated out from the depreciation. So the tires are considered as separate items. So for the rubber tired equipment, the value of the tires should be subtracted from the amount to be depreciated, because the tire cost will be computed separately as an element of the operating cost. So in this case, the tires can be considered as the operating cost elements, because these tires have to be replaced also more frequently as the other parts of the equipment. So this is something like special for the construction equipment. The salvage value should be estimated as realistically as possible based on the historical data. One thing for the calculation of the depreciation is the estimation of the salvage value. Salvage value is the value of the equipment estimated that will remain after the useful life of the equipment. So for example, if the car is purchased now, say $25,000, so it may be estimated that 5 years from now, its salvage value may be like $10,000. So that estimate of the value of the salvage value for the remaining value of the car or for any other equipment will be based on the historical data from the past records. So, and here, of course, the judgment of the experienced estimator may play a very vital role. The equipment life used in calculating the depreciation should be correspond to the equipment's expected economic or useful life. So normally, of course, you can use an equipment for a prolonged period of time. Okay, so for example, if a crane is purchased or if some other excavator is purchased for the construction, then that excavator may be used for quite a long period of time, but its economic life may not be as long as the equipment's own life. So for beyond that economic life, the cost of owning and operating the equipment may be much higher. Okay, so therefore, when we are calculating the useful life of the equipment for the depreciation purpose, a proper value should be used, which is normally not as long as the end of the service life of the equipment. So the equipment life used in calculating the depreciation should correspond to the equipment's expected economic or useful life. Okay. Next, there are some guidelines for the general construction equipment. Most of the construction equipment which is used, they use 5 years as the life for the purpose of the depreciation. So this is actually recommended by the Inland Revenue Services from USA, and it may be the case for most of the other countries as well. So in this chapter, we will normally take 5 years as the useful life for general depreciation purpose. So although the equipment may be used beyond that 5 years of life, but in most of the cases, the economic life for the equipment is generally considered as 5 years. So we take same period as it is for the depreciation purposes. So now there are various methods the depreciation is calculated. So these methods are the straight line method, sum of the years digits method, and the double declining method, balance method, and the another method which is called as the MAC-RS. So we will consider look at these methods one by one. So the straight line depreciation method assumes that the value of the equipment decreases uniformly, okay, over the period of time. Okay, so there is a straight line depreciation. So it means that as an example one, if we say that if an equipment which costs $50,000 now, and its salvage value is $5,000, that means we estimate that after 5 years of its expected life, it can be sold out for $5,000. So in that case, for over a 5-year period, every year its value will decrease by $9,000. You can see that $50,000 now, after 5 years, $5,000. So total decrease is $45,000. So $45,000 divided by 5 years. So each year the decrease in the value of the equipment is $9,000. So this is just an estimate. This does not mean that each year the value of the equipment will really decrease by $9,000. It depends on the value which we can get, or for if you want to sell that equipment after 2 years. So it will depend on the market value at that time. But we don't know anything now. Because we are talking about 2 years from now. Okay, so that's why we are going to estimate it by some method. So straight line depreciation method is one of that estimation method. Okay, so by this method, the depreciation each year is $9,000, uniform depreciation. So since it is a uniform depreciation, its book value at the end of the period will be like decreased by $9,000 each year. So $50,000, $41,000, $32,000, $23,000, $14,000, and $5,000. So remember that we are saying that it is the book value. Okay, it is to be it may or may not be the same as the market value at the end of 1 year. So we are just saying that it is a book value. So the book, we use this term book value for accounting purposes, because by this book value we may be also preparing our financial statements as well. So that's why we use the book value. We don't use the term market value. Market value will be the actual value, but we don't know as of now, because we are talking about the future over here. So therefore, this we use the term book value in this case. So you can see that in this straight line method, the book value decreases in a uniform way over the number of years. So this is the one of the simplest of the method, but this type of method is not very useful for the tax purposes, because it does not decrease the value of the asset quite rapidly in the initial years of the services. I don't have the time to explain this concept, why it is like that, but because that will be the topic of the full engineering economy course. But as of now, I will only state like this. But there are some other methods, such as the sum of the years digits method, which reduces the value of the asset much quicker in the early years of the life of the equipment. Okay, so sum of the years digit method uses this formula. The application of this formula is quite simple. So let's see it with the help of this example. So consider the same equipment as we used in the example 1. So remember that the purchase price or the initial value of the equipment was $50,000. You can see that initial cost was $50,000 and its salvage value is $5,000. So if we want to calculate the depreciation in the first year, it is $15,000 in this case. Why? So first you will take the $50,000, then you will subtract it from the salvage value, and then you will multiply by a ratio. And what is that ratio? So this ratio, there is a numerator and then there is a denominator. So the denominator is constant each year, which is 15. And what is 15? 15 is the sum of the number of sum of the number of years. Yes, say what? Say again what you said.
Summation of all numbers before 5. 1, 2, 3, 4, 5.
Yes. So if we are using a 5 year, then we will use 15. So that will be 1 plus 2 plus 3 plus 4 plus 5. Similarly, if we are using 7 years, so it will be 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7. Okay, in this way we will go. So so we will use 15. And then we will start for the first year, we will start from 5. Okay, that means in the reverse order. For the second year, we will take 4. So third year, we will take 1 less. So in this way, we will go like this. So you will see that we are reducing the value of the asset much quicker in the earlier years. Okay, so if I compare it with the previous case, every year we are reducing is 9,000, right? But here we are reducing it much quicker in the earlier years, but in the later years, much slower than in the straight line method. So this type of distribution is much useful for the filing the tax purposes. So as of course, again, it is now difficult to explain it now within this short period of time, but this type of pattern is always preferred by the construction companies, and it is also acceptable by the government authorities as well, that they can depreciate the value of the asset much quicker earlier in the life than later in the life. So in this case, now we can get the book value like this. So $50,000 and then reduced by $15,000, it will be $35,000. But earlier it was $41,000. And similarly, we can get the book value. That means the value of the asset remaining after each year. Okay, but remember that again, it is the book value. It is not the market value. Market value will be the actual price for which we can sell it. This is just the estimated value. Okay, and this was the sum of the years digits method. The other method is the double declining balance method.
Professor, I have a question.
Yes.
In both examples, as a final solution, we got salvage value. So does it mean that if we solve correctly, as a final result, we should get salvage value?
Exactly. Yeah, I just forgot to mention this point. We should get exactly the salvage value. But this is not the case in this double declining balance method. Okay, so this is the difference from here to here. But in this case, in the double declining balance method, let's see it with the help of the example. Okay, in the double declining balance method, okay, the main concept over here is we reduce the value of the asset as a fixed percentage each year. Okay, and the value of the asset as a fixed percentage each year is based on the latest book value at that time. Okay, so this is the difference. So so this double declining balance means that we can get a ratio which is 2, which is for double. 2 means for double means 200%, and then 2, then we will divide it by the n. N is the for number of years which we want, for which we want the equipment to depreciate. So let's see this quickly over here. So because we want to apply the double declining balance method, we have 2, and then we can divide it by divided by 5. Okay. Although it is not mentioned in this book, there is another method which is called as the 150% declining balance method. So, but that 150% declining balance method also is used, but for most of the cases, we use the 200% declining balance method, which is also called as the double declining balance method. So in the 200% declining balance method, in the formula, we have this 2. This 2 comes from this double or 200%. So 2 divided by 10 divided by n, which is the number of years which we want the asset to depreciate. And then we will multiply it by the book value at the beginning of the year. Okay, so remember that the book value at the beginning of the year will change every year. Okay, So book value at the beginning of the first year is the actual value, which is $50,000. So in the $50,000, then because we already get this ratio 2/5, which is 0.4. So $50,000 multiplied by 0.4, it will be $20,000. So for the next year, we will not use this $50,000. We will use the book value. So 50,000 minus 20,000, we will use $30,000. And then that $30,000 will be multiplied by this 0.54. So you can see that for each year, we are multiplying by a constant ratio, but this value will change because that will be the latest book value at that time. Okay. So in this case, it is not guaranteed that at the end of the period for which we have assumed to be over here, be 5, we will reach at the salvage value. So for example, over here now, D4, we reach a depreciation value of 4,320. So if we take 10,800 and subtract 4,320, we get 6,480. But 6,480, if we take its 40%, then we will get 2,592. But now if we take 6,480 minus 2,592, it will be less than $5,000, which is the salvage value. So we cannot go less than the salvage value. Okay. So in this case, then in the 5th year, we will change our method. Okay. And instead of, because it is giving us a value of less than $5,000, so we cannot go less than $5,000. So we will, by force, we will put it $5,000 over here. And then with the difference of this value, 6,480 and 5,000, we will put a value of depreciation in the last year as 1,480. So in this way, we can achieve the salvage value. So the advantage of this method is the same as in the sum of the years digit method. It also depreciates the asset earlier in the life of the asset, but the disadvantage is that we cannot sometimes we cannot reach to the salvage value, but we need to use some other methods such as the straight line method to reach to the salvage value of the asset. Okay.
Professor, I have a question again. Why 2/5? So 2 is
why? What?
depreciation factor. Why 2/5? Why 2?
It is yes, it is because it is called as the double declining balance method. So in the double declining balance method, we have to choose a constant ratio. So the constant ratio will be 2/5 in this case, because it is a double declining balance method. So 2 comes from that double, and 5 is the number of years which we want to depreciate. So that's why it is 2/5. If, for example, if you want for 7 years and it is a double declining balance method, you will use 2/7.
Okay. And Professor, and one more question about the $5,000. I little bit didn't understand what. So salvage value, yep. Or
Yes.
which one? Yeah, what does
salvage value? So $5,000, $50,000. Of course, it is the initial purchase price. For the depreciation purpose, it is necessary to choose the salvage value of the equipment, whether it is a 0 or any other value. We have to choose it. And in your depreciation schedule, you should always show that what is the salvage value. So the depreciation schedule will be only valid if your depreciation schedule reaches up to that salvage value. So in this case, since there is, we are always taking the constant ratio as a percentage of the book value, it is not guaranteed that you can reach to the salvage value. So therefore, at the end, in the 5th year, we have forcefully put the salvage value over here, and then we calculated the depreciation as a difference of 4,6,480 and 5,000.
How do we know that? How do we know this salvage value? So in practice, I mean,
We don't know it. We need to estimate it. So most of the most of the numbers which we use in the financial management, financial analysis, these are the estimated values. So we don't say that we know it. We say that we estimate it. So if we buy the equipment now, $50,000, so we will assume that it may be based on some historical record or from some manufacturer's recommendation or our intended use of the equipment. We will assume or we will estimate that this will be the salvage value.
okay. And one more question. So what will be of the 6th year? If the-
6th year?
yeah, but I
No,
mean,
they-
salvage value. So
So because we are only making the financial analysis for the 5-year period. So after in the 6th year, we will assume that we are already we have already disposed of that equipment. So we will no longer use that equipment in our financial documents. Okay. Okay. So since once we assume that its useful life will be 5th year, so there is no 6th year. Okay. So in the 6th year, if we want to continue it, then we need to buy the new equipment and then perform another replacement analysis for the equipment. Do you understand? Okay.
yes, thank you.
All right. So, okay. So, okay, let's stop at this point and then we will continue this topic in the next class.